All right, Canada's latest retail sales numbers are up 1.3% for November after a deal was reached in BC to end a labor dispute that affected the province's liquor distribution branch. Let's get more insight on this from Norman Levine. He is portfolio manager of Brook, Wagman Private Wealth Management at Raymond James. Norman, thanks for joining us.
Welcome from Aruba.
Is that where you are?
I'm dressed.
I'm looking at the T-shirt. It's a casual Fridays taken to the extreme.
Right in from the beach. So retail sales were up in the month, but it's very deceptive because they were led by the first group that led it was beer and wine and alcohol and spirits, and then the second was food. So you've got booze prices going up, which are causing that to happen, or people spending more. And Canada has the highest in food inflation in the G7 by a lot. So that's why your prices, your retail sales went up. It's a very bad number other than that. And it shows that the Canadian economy, especially compared to the US economy, is actually stagnant with signs of inflation, which I don't want to use the word too casually, but is it the first signs of stagflation? Possibly.
What are some of the numbers that are giving you that indication?
Well, if you've got food inflation up over 7% year over year, and you've got sales basically flat when you take out the booze sales. So to me, economy not growing for the consumer, and the prices that consumers are paying are higher. I'm not looking at total economic pricing, that hasn't been reported yet, but retail sales, that's just showing that the possibility of stagflation is there, whereas in the US, you've got an economy doing better and projected to do better. So they're not having the same issues that we are here.
And the prediction for December, I think, was down. Sales would be down for December. How do you bring that in, and what does that mean?
Well, okay, so once again, you've got sales coming flat or down and prices staying stickily high. That doesn't portend well for the average Canadian consumer who is hurting. We've got, as I've talked to you about in the past, we have a K-shaped economy where the well-to-do and the boomers are, I'm one, but the boomers are doing well, whereas younger people are struggling to get jobs. They're struggling to pay for rent and homes and for food, and that doesn't portend well for the economy.
All right, and people are looking for places to go with their money. Gold right now is up. Just looking, it's back. It's closing in on 5,000. Not quite there. It's still up for the day. How are you treating that right now?
Well, I have some representation in the precious metals. Silver has gone parabolic, and it scares me, but parabolic moves can go a lot higher than people expect for longer before coming crashing down. But people are moving into precious metals because they're afraid of all the government spending going on and afraid of interest rates, long-term interest rates going up because of that. So the way I'm playing it is I don't own an individual mine. That I've learned from 50 years in the business that owning individual mines or mining companies can be dangerous even when the commodity is going higher because of problems that can happen at individual mines or in countries where they're located. So I own Franco-Nevada, which is a royalty, which gets royalties from other companies' production in gold and silver. They're also into energy and some other commodities as well. So it's not as dramatic as the moves in gold and in silver, but to me, it's a lot safer place to be.
And where are the royalties coming from? Are they mostly North American or all over?
Roger, they're around the world. The company was started, and the reason it's called Franco-Nevada is they were getting gold royalties out of properties in Nevada, but now it's a worldwide company getting as I said, royalties on gold, on silver, but also on iron ore and on crude oil and some other metals, copper, etc. So it's a good way to play without a lot of individual risk.
And you're starting to turn towards small caps as well right now.
So small cap, when I first became a portfolio manager in the early 1980s, and for the next 10, 15 years, I managed small and mid-cap portfolios. I learned that there are times in the cycle, economic cycle, market cycle, when small cap stocks outperform and times when they underperform. And I also learned that buying individual companies takes a lot of work that most investors aren't prepared or can't do. You have to really kick the tires on individual companies, meet with management, go see their facilities, see if they're for real or not. And then you go through periods when the companies do well, the stock does nothing because nobody cares. So I've discovered that it's better to own the small cap indexes rather than individual companies. And I'm playing the IWM, which represents the Russell 2000 in the US. And it has underperformed the S&P 500 for 14 straight years. And so the valuations on small cap stocks are much lower than large cap stocks. And they are now starting to outperform for the first time in 14 years. So I still think it's pretty early going for them. And what's behind that is they've benefited from lower interest rates, from lower energy prices, and also from the fact that the vast majority of them are domestic in nature. They're not multinational like most of the companies in the S&P 500.
Okay.
And with the U.S. economy doing better than people expected, with tax refunds coming to people, I expect that the U.S. economy, especially for individuals and for smaller companies, is going to do well. So that's why I'm recommending owning IWM. I don't know if your people were able to get the chart together that I was looking for, showing either the Russell 2000 or the IWM and versus how the S&P 500's been doing.
We couldn't do it, unfortunately, but we're also out of time right now, Norman. Thanks very much for joining us. We'll let you hit the beach right now. Enjoy the break down there and the weather. You're not missing much up here right now. So
no, thank you, Roger. Stay warm.
We'll try. Norman Levine is portfolio manager at Brook, Wagman Private Wealth Management with Raymond James.